Hi, everyone. Wow, 50,000 on the Dow. We know that that is just a number, and milestones like that always get attention. But what matters more is why markets are reaching these levels. Right now, we don't think it's just enthusiasm. It is being supported by economic growth and corporate earnings. So I want to briefly cover a few things today. Number one, the economy. So U.S. economy continues to expand. The trend line of growth in the economy, if you're looking at GDP, back to like 2000, has been around 2%. Of course, COVID happened, it pulled back, it caught back up. The last two readings were 3.8% in the second quarter last year, 4.4% in the third quarter. Remember, those numbers are net of inflation. So nominal GDP growth is really closer to 7%. Pretty cool to see that. Now there is volatility with those readings, but it is nice to see these upticks and nice to see numbers that are north of two. So overall, on a broad base, the economy is expanding at a healthy level. That's good. And what it tells us is we're not really in a fragile environment currently. This is a maturing expansion. Growth is stabilizing. It's not collapsing. Historically, markets can continue doing well in this type of environment, but historically, we during the time like this, we'll see leadership in the market start to broaden just beyond a handful of companies. That's exactly what we've been waiting for. So we'll see if that continues. It's happening so far in 2026 here. Number two, corporate earnings, always going to be at the forefront of the things we look at. They continue to support the market expansion. So about three-quarters of S&P 500 companies beat expectations this earnings season. Overall, earnings are running in the high single-digit to low double-digit growth range, which is healthy. And it also means that markets now need continued execution. Markets are pricing in higher and higher levels of optimism. So it isn't just we need to see those high earnings numbers to keep moving higher. Now we need to see those just to stay where we're at. So it is good news when we see earnings continue to grow. Let's hope that continues as well. Another headline, the Federal Reserve. So it's a big factor all the time. We're transitioning to a new chair, it looks like. And I think as a regime change, not just a new individual, but also from inflation control, maybe more towards growth management. And this is kind of call it a slow rate cutting cycle. I think that's what the market's pricing, and that's what we're expecting to see. And historically, that phase of a shift might create some short-term volatility because markets try to predict the timing before the Fed actually acts. But over time, easing policy tends to extend economics expansions rather than just end them. So I think that is a good thing. But it also presents one thing that we are watching. There's a couple things we're watching, but number one, related to the Fed, if we see rate cuts coming in too aggressively, the economy could heat up and we could see inflation come back into play. Nobody wants to see that. That's how you cause a recession. So we don't want to see inflation come back in. Another thing, AI is starting to change hiring behavior. And we're starting to see particularly those entry level white collar jobs are getting harder and harder to find. Fortunately, companies are investing in productivity more than headcount. And that might be great for profit margins, great for earnings, but what's it going to do to the labor market and the economy on a more broad-based scale? The last thing, global trade tensions, the tariff conversation, it's not really in the headlines as much anymore, but it hasn't gone away. So there could be some pressures there as well. None of these things point to like an imminent downturn all by themselves, but they do just reinforce the importance of why we diversify and why we don't want to be overly extended in a handful of stocks. So one more thing for some longer term perspective, I want to pull a chart up here. Can this market go higher? So what we're looking at is the concept of the secular bull market. And what it means is historically, the market averages, 9 or 10% per year over time, but it doesn't always come on an even basis. What I mean is we'll see periods of 10 to 12 years of stagnation and then 19 to 20 years of growth. And it happens again and again. So where are we today? Today, if you just follow the pattern, We're about halfway to 2/3 of the way through from the last new all-time high to, the potential generational peak, as you could call it here. Happens to be the first two stretches like this were each 19 years. If this one's 19 years also, that means we got another 6 years or so. That is certainly not a guarantee. Every market is different. Every bull run is different. And don't forget, there's always volatility baked even within those big climbs that we've experienced. So in the short term, anything can happen, but uh, the overall message is this: the market reaching 50,000, it does reflect strong fundamentals. It's not exuberance, but the next phase of the business cycle will, we think, probably reward diversification more than concentration as this rally continues to broaden. So as always, if you have any questions or thoughts or want to know how this relates to you or your plan, please don't hesitate to reach out. We're always happy to help. Thanks.